In the first lecture on this series, we revisited the structure of real estate finance. We looked at forward funding as differentiated from forward sale. In this lecture, I'll be looking at bridging finance, and specifically, I'll be looking at the concept of bridging finance, or what we would otherwise refer to as gap financing. I would also look at the different types of bridging finance, and I would look at the advantages and disadvantages associated with bridging finance. And then in the last lecture, I will look at this idea of mezzanine finance. Okay, so let's look at this idea of bridging finance. Now, many times in property development, access to finance, both short-term and long-term finance, are required. However, short-term finance, access to short-term finance actually, is often a function of the availability of long-term finance. So banks, which are often the source of short-term finance to developers, will restrict access to finance because developers are yet to demonstrate their access to long-term or permanent finance via investors, either institutional or individuals. So, in what scenarios will the need for bridging finance emerge? Now, let me give you a very simple scenario. As students, we might have a short-term need, but for example, we may need to buy a book, or we may need to purchase a tool for a particular assignment, but we may not have the money at that moment. Our parents may have promised to send the money a week or two after you have told them. Now, between the time you tell your parents and the time, the 2 weeks the money is delivered, the assignment must be completed. And so you decide to take a loan from your friend to be repaid when your parents send in your money. That gap in financing is actually what bridging finance is essentially about. You took a short loan from a friend to bridge that gap in financing that you faced. In property investment or development, the need for bridging finance may also emerge in a number of ways. So let's look at them. The very first one is that developers need both short-term finance for development or construction of property, for which an investor is willing to buy, usually through forward sale agreement, but payment for the project, which will provide long-term or permanent finance to them, is only available upon delivery of the project. So the developer will need to fill the gap in finance by using a bridge or a gap loan. The second example is the situation of some homeowners who want to use the proceeds from the sale of their current house to purchase a new house. That may take a long time, and they may lose out on opportunity if they have to wait for their property to sell. So in the interim, they can use a bridge loan towards the purchase of the new house while they wait for the current house to sell. Borrowers can use the equity in their current house for the down payment on the purchase of a new house. This happens whilst they wait for their current house to sell. This will then give the homeowners extra time and therefore some peace of mind while they wait. Another example relating to homeowners is that in terms of bridging finance, is that they can also use bridging finance to meet out down payment requirements for a new home. Okay, so that is another scenario. And then the last scenario is that you would have a situation where companies may need bridging finance to finance working capital or cover expenses as they wait for long-term financing. They can use the bridge loan to cover expenses such as utility bills, payroll, rent, and inventory cost. Distressed businesses can also take up bridge loans to ensure the smooth running of the business while they search for a large investor or an acquirer. The lender can then take an equity position in the property to protect its interest in the company. So, having given this concept, what would we or how would we formally define a bridging loan? We would say that a bridging loan or gap financing is a short-term loan used to finance a person or a company to secure permanent financing or to remove an existing obligation. So it allows the user to meet current obligation by providing immediate cash flow. Bridge loans are often short-term loans up to 1 year and have relatively high interest rates and are usually backed by some form of collateral such as real estate or inventory. Okay, so having gained an understanding of the concept, let's look at some of the different types of bridging finance available. So there are essentially 4 types of bridging finance. We have the closed bridging finance, open bridging finance, first charge bridging finance, and second charge bridging finance. Let's look at the details of each of these types. So in terms of closed finance, these are the 3 main characteristics that you need to look out for. So closed bridging finance is available for a predetermined time frame. It has a greater degree of certainty about the loan repayment, and it attracts lower interest rates than an open bridging finance. The 3 characteristics you need to look out for when you are looking at open bridging finance are: 1, it is available for an undetermined time frame. This is unlike the closed bridging finance. And it also comes with a greater degree of uncertainty about the loan repayment, unlike the closed bridging finance. And it also attracts a higher interest rate than a closed bridging finance actually. Yes. And then the other 2, which is first charge, we are saying that lenders receive its money first before other lenders. So basically, if we say that you have a first charge against a collateral or against the cash flows of a company, it means that that company will prioritize the payment of your loan compared with other lenders to that same company. The second characteristic you need to look out for is that there are low levels of underwriting risk when it comes to that. Because your repayments are prioritized, it reduces the risk associated with that type of a loan, which may be very important, especially if the cash flows generated by the company may not be enough to service all their lenders or their creditors. And then the third characteristic you need to look out for is that the first charge bridging finance attracts a lower interest rate than the second charge, which is much more riskier. So what are the characteristics of the second charge? So we say that lenders, unlike in the case of a first charge, receives its money after the first charge lenders. Because of this arrangement, the lenders are exposed to a higher level of underwriting risk, and hence they will charge a higher interest rate than the first charge will do. Okay, so let's look at the advantages and disadvantages of bridging finance. We can look at least 4 main advantages and disadvantages of bridging finance. The very first one is that bridging finance allows you to secure opportunities that you would otherwise miss. The disadvantage is that bridging finance may leave you debt burdened in the short term. That is, some borrowers may find themselves paying 2 mortgages and a bridge loan at the same time. So that can be a serious situation to find yourself in. The second advantage and disadvantage is that in terms of advantage, a bridging finance is it is easier to qualify for a bridging finance than a traditional loan, and more financial distress. The borrower or the developer may find him or herself in more financial distress if the lender forecloses upon default, and that might leave the developer with no home, or the homeowner who already had an existing home with actually no home. So that can be a big disadvantage. Now let's look at the third advantage. And here we are saying that the developer, usually in a bridge finance, less time is involved in getting approval than in a traditional loan setting. And for this advantage, a bridge finance is often costly due to the high interest rate associated with them. And then the last advantage and disadvantage of bridge finance is that in terms of advantage, bridge finance is often offers flexible payment terms depending on the loan agreements, which may be before or after securing long-term finance or selling the old property, or when the new project has been constructed. In terms of disadvantage, it comes with borrowing conditions that limit your borrowing options. So for example, the lender who is providing bridging finance may also put in a conditional clause which will say that you can only take a mortgage from that same bank, which means that if other banks are willing to offer you a loan, you may not be able to take that loan or take advantage of that loan because you are limited or restricted by a conditional clause in a bridging finance loan. These are the bits on bridging finance. I expect you to have some questions. If that is the case, let's interact on the Google Classroom platform. Post your questions and I will respond to all of them. In the next lecture, as I indicated earlier, I'll be looking at mezzanine finance. Thank you for watching. Bye.